not a good thing for the economy. Gold was money. One of the best pieces of advice I've ever had. He said, don't wait until 2025. $1,000 gain is $1,000 gain. A gold mining company is a leverage bet on gold just because of the economics of stocks versus gold. It's not a good thing, and I agree. It's not a good thing for the economy. It's not a good thing for most Americans. If you have gold, you can pat yourself on the back and say, yeah, I made a lot of money on gold, but that might be in a world where you're losing a lot of money on other things, and you need to be alert to the overall economic picture. So let's take this one at a time. The gold $15,000 an ounce, it comes out of three different analyses that actually don't correlate to each other. In other words, you do it one way, you get a number, you do it another way, you get a number, you do it a third way, you get a number. It was interesting that they all came out not exactly to the penny, but very close to that $15,000 number. So the first way to do it is just, it's a little bit of technical analysis, not overly technical. We're in the third great bull market in gold in history. When I say in history, you're like, well, gee, history is a long time. How come this is only the third bull market? Well, the answer is for almost all of history up until 1971, gold was money. So you didn't have bull markets or bear markets. It was just gold. That was the money. And you thought about it by weight. You say, well, I'll give you an ounce of gold for this property, or I'll give you, a quarter ounce for, some food or groceries or whatever. So you thought about gold by weight. It was money, constant store value. So it's really only since 1971 when Nixon suspended redemption of dollars for gold by our foreign trading partners, that gold just went its own way, detached from the dollar. So the dollar would do what it was going to do, and gold had its own market and still does. I had a conversation with our friend Jim Rogers, one of the greatest traders in general, and certainly one of the greatest commodity traders of all time. And I said, Jim, we were down in the Dominican Republic. I said, Jim, you buying gold? And he said, no. He said, I've got gold. I'm keeping the gold I have. I'm not buying more right now because it hasn't hit bottom. And then he gave me one of the best pieces of advice I've ever had. He said, Jim, nothing goes from here to the moon without a 50% drawdown along the way. It'll get there, but it'll go up, down 50%, and then back up for the really big, sort of hyperbolic price move. We said, and you have to expect that. It's true of all commodities. If the first bull market was up 2,000%, and the second bull market was up 700%. If you just take the average of those two, you don't have to pick the higher of the two. You don't have to go crazy or say it'll be bigger than ever. It could be, but you don't have to do that. If you just take the average of those two, you would come up with a number around 1,400% gain from the 1050. Well, that would put you at almost $15,000 an ounce. So in other words, and the same time period, the first bull market was 8 years, 9 years. The second bull market was 12 years. Just take the average, you get 10 and a half years. So from December 2015, just using the averages, not anything crazy, 10 and a half years up, 1,500%, bingo, it puts you at $15,000 an ounce in 2025. And by the way, don't wait. If you agree with that analysis, and there's more to back it up, don't wait until 2025. People say, oh, okay, well, it's going to be $15,000 an ounce. I'll go out and get it in 2024, I'll catch the wave. No, it's a long way between here and 1,500. I mean, you got to get to 3,000, 4,000, 5,000, 6,000. 7,000, et cetera. You got a long way to go to 15,000. So why not get the gold now, which I do recommend, and then enjoy all those profits? Don't wait to the end, because it could happen. There could be like a little spike at the end. This is sixth grade math. You don't need calculus for this. Each $1,000 gain is $1,000 gain. If you have an ounce of gold and it goes up $1,000 an ounce, you just made $1,000. That's real money. But because you're working off a higher base, each $1,000 gain is a smaller percentage than the one before. So when you move from $2,000 to $3,000 an ounce, that's a 50% gain. But when you move from 14,000 to 15,000, it's only a 7% gain. So that's why these bull markets get a lot of their gains toward the end, because 7%, that's a week. And then you might have to wait a while to get to 3,000, but if you're at 14, you're not going to wait long to get to 15. 7% could be a 1 week rally. So in other words, those $1,000 increments are smaller percentages and easier to achieve the further along you go. One more reason to get the gold now. So that's one analysis. The second analysis is if you just use a monetary analysis. I'm not saying we're going to go on a gold standard. We may, but right now there's not a central bank in the world that wants a gold standard, not one. They hate it. But they may be forced to go to it or something like it, because if confidence is lost in government money and fiat money, they may have to turn to gold, not because they want to, but because they have to restore confidence. So what's that math? Well, the global money supply is about, I'm using M1 and the major economies, which is about 80% of global GDP, is about 33 trillion. And there happen to be about 34,000 tons of official gold. That's not all the gold in the world. That's the official gold held by central banks and so forth. Well, you just do the division. Okay, divide the 33. Take the 33 trillion, and just say you need 40% backing. Some people would say 100%, but historically 40% has worked pretty well. So you need about 12 or 13 trillion dollars worth of gold to back up that money. Well, if you have 34,000 tons and you need about $13 trillion of gold to back up the money supply, what does that come to? We'll just divide by one by the other, and again, you get a number close to $14,000 an ounce. So there are two completely independent methods. One is the technical historical look. The other one is a monetary look based on money supply. But interestingly, they come out in the same place. Okay, what does it mean? Isn't this great? Well, gold's going up. I'm making a lot of money. Well, maybe you are, and other people are who have gold, and I certainly recommend it. But to me, the price of gold never changes. I think of gold by weight. You have an ounce, you have a kilo, you have a ton, you have a 400-ounce bar, whatever you may have. If the dollar price of gold is going up, what's really happening is that the value of the dollar is going down. Because gold is a constant store of value. So if all of a sudden, if $2,000 gets me an ounce, but we get to a world where it takes $5,000 to get me an ounce, what happened? The value of the dollar went down. I need 2.5 times more dollars to get the same ounce. So a high dollar price of gold is again, good for gold holders, but not cause for celebration, because it means the complete and utter collapse of the US dollar. That's what happened in the 70s, and that's what's happening now. Berkshire Hathaway, which is Buffett's investment vehicle, is so big. We're talking, upwards of $1 trillion. You can't buy junior miners. Junior miners can be very, very attractive investments, but they don't move the needle at Berkshire Hathaway. You got to be spending $500 million just to kind of get on the list. Well, there are only a couple of mining companies in the world that are that big. Newmont, Barrick, IAMGOLD, there are a few, but that's it. So Buffett's not going to be able to buy junior miners anywhere. He doesn't have the time and the ability to attract them. He needs a big name, and Barrick is one of the best. Interestingly, the way Barrick's going to make their money, they'll make money in gold for sure, and their stock price will go up, and it's a smart move by Buffett. But they're not going to make it by exploring. They're going to make it by buying junior miners. That's why for an investor a little bit smaller than Berkshire Hathaway, the junior miners can be attractive. So they'll just wait until other people do, hit a good gold mine, prove it out, start mining, start producing, then they'll just buy that company and add it to their output. A gold mining company is a leveraged bet on gold just because of the economics. You have fixed costs and variable costs. Well, once you cover your fixed costs, and assuming you can control your variable costs, as the price of gold goes up, all that money goes straight to the bottom line. Initially, you got capital costs and leasing and geological surveys and all kinds of things. But once you get producing and you cover your fixed costs, a lot of the incremental price of gold goes to the bottom line. The stock market gives you a multiple of that. So the answer is, if gold's going to go up 5 times, which I expect it will, or more, a mining stock could go up 25 or 50 times, just because of the economics of stocks versus gold. Gold is competing with money markets, let's say. Well, let's flip from bonds to the money market, because that's the most liquid form. Money market funds, bank CDs, short-term investments, etc. If gold is competing with these money market or substitutes of money market funds, and their rate is 0, and gold's yield is 0, then it's a fair fight. Now it's all about capital gains. Now, obviously, we already talked about in the last segment how you can make 10 times your money in capital gains on price of gold. But if you're comparing yield to yield, even assuming the price is going to be constant, it's a fair fight. If they're both at 0, then take your pick. For the investor, for someone with money, absolutely have your gold and silver, but I'd have some treasury notes side by side, because they're set up for very large capital gains because interest rates are going to go even lower. And the people say they can't go lower. My answer is, just watch, because Germany has negative rates. Japan has negative rates. The U.S. still has positive rates. Rates could go a lot lower.